return to confidence.
Watch Budget 2018 with Bloomberg Quint.
Good afternoon. You're watching Ask BQ on Bloomberg Quint Live, and I'm Navneet Saluja D'Souza. Well, this is the show where we address all your stock queries, so you can write to us on Twitter, Facebook, or just call us on 022-4540-4141. You can also mail your queries at askbq@bloombergquint.com, and we'll try and address as many as possible on the show. But just remember to add the AskBQ hashtag. All right, let's take stock of the markets. What's happening? Well, the template doesn't change. Just when you thought that there was no selling, once again, there is selling that has come in at higher levels for the broader markets. If you could just pull up the indices, as you can see, Nifty is once again off day's high, currently just about holding up in green with gains of almost 12 to 13 points. And same is the case for the Bank Nifty, which is still holding about good gains of almost 0.5%. 26,658 is where a Bank Nifty is trading. But it looks like the Nifty PSU banking space, which saw a sharp rebound today, has slipped once again in trade. As you can see, it's off day's high, and the private banking index is trading with gains of 0.4%. I want to pull up the intraday chart, if we can, of the Nifty mid-cap index. We did see some sort of strength coming back into the broader markets, but the intraday chart will tell you we're currently almost at day's low, mild bit of recovery from those lower levels. But in the red, the Nifty mid-cap free float index is trading with cuts of 51 points at the moment. In terms of sectors, what's not doing well, the Nifty Realty Index, after tumbling 4% yesterday, is down once again, cuts of 0.5% seen. The Auto Index is down 0.5%, and also you've got metals, pharma, media, as well as IT have come in under pressure in today's trade. While talking about the market breadth, which has been in favor of the declines in the last at least 2 to 3 sessions, let's just pull up the NSE stats, which will tell you what's the current status when it comes to the market breadth. I think it is still in favor of the declines, considering the kind of fall that we've seen for the broader markets. And look at that yawning distance that you can see. Now the declines have taken over the advances. The market breadth currently is about 1:2, clearly in favor of the declines. Let's just pull up the contributors list of Nifty constituents and tell you which are the stocks which are contributing today. ICICI Bank, I think it's the 5th straight day of gains for this counter. Reliance Industries comes out with its numbers in the evening. Ahead of that, some positive tick, and HDFC Bank is also trading in the green after posting stable set of numbers which were in line with street estimates, and SPI too is trading in the green. What's capping the moves today on the upside are your heavyweights. Infosys, that's also trading with cuts. In fact, Infi, Ultratech Cement, Maruti, Sun Pharma, all these counters have seen mild bit of pressure. Okay, then, without any delay, let's get our two experts. Gaurang Shah of Geojit Financial Services and Rakesh Bansal of RK Global are here to answer all your queries. Welcome to the show, gentlemen, and good afternoon to both of you. All right, our first query.
Good afternoon to you.
Good afternoon. Moving on, our first query for the day comes from Shah, who has written to us on Facebook. Shah wants to invest in MRF with a long-term view, and he wants to know if this is the right time to invest into this counter. I'll take this question to you, Gaurang. A view on MRF at these levels. I don't know how liquid is the counter for any retail investor, at least, to enter into, but would you advise anyone to deploy their money here, or you like the other tire stocks?
Well, Navneet, to be very honest, if you have a long-term time horizon, you should not be deterred with the liquidity in the counter. And it's not like you are going to buy, huge quantity of it, given the kind of valuation where it is traded. I'm talking about specifically retail small investors. As a disclosure, right from 25,000, we've been maintaining a positive view on MRF. It is trading at close to 70,000 per piece, if I'm not mistaken. Correct me if I'm wrong. And we have a buy coverage on MRF. So I would definitely advise Shah to go ahead and buy it. He has chosen a stock with extremely best of the pedigree capabilities and capacities.
Okay, Shan, so Gaurav advises you can look to buy MRF at these levels as he is bullish on the counter. Let's move on. Our next query comes from Ranjit, who has written to us on YouTube. Ranjit has 125 shares of Kaya, which he bought at a price of 800 rupees. Ranjit's got 5-year view and he wants to know what should he do with this investment. And currently, 1067 is the price where Kaya is trading, so almost 250 to 260 rupees in the money, Gaurang. Kaya has been in focus, at least in terms of the stock price movement. On I think one of the days this week, it was locked in upper circuit as well. Do you track this counter?
We do have a positive coverage, and in fact, right from the time we heard about the corporate development for Kaya, we have seen the stock maintain that higher trajectory level. And I think as we go forward, the semi-urban and rural population, when there realization about such kind of health activities are to be taken care of, business is definitely going to go to a much more elevated level. I would be more interested in listening from the management about their commentary in terms of the expansion in the semi-urban tier 2, tier 3 cities are concerned, because that's where I think the large part of now revenue will come from. So we remain positive. You can continue to hold.
Okay, so positive view on Kaya, 1068. The stock, however, is mild bit under pressure with cuts of 0.5%. Himanshu Goswami is the next one who writes to us on Facebook. Himanshu has 500 shares of Syntex Plastics, which he bought at a price of 85 rupees. He does have a long-term view. He wants to know what should he do. We'll do a chart check on this. Rakesh, Syntex Plastics, I know the history will be limited since it is the demerged entity of Syntex Industries, but what does the current trend signify on the charts for Syntex Plastics?
A very good afternoon, Navneet. Navneet, if you talk about Syntex Plastic, it's a new listing after the demerger of Syntex. I feel the entry price is good, 85. One should clearly hold, and stock prices are making a good base at around 70, 75 levels on the downside. On any decline to around 80 rupees, 77 rupees, one can add more. I am expecting a target of 135 on the upside in next 18 months. Stock is a clear hold. One should hold for a target of 135, and I am expecting we might see these targets coming in next 18 months.
Okay, so hold on to your investment in Syntex Plastics. That's the view coming in from Rakesh on the charts. The counter is trading around the levels of 75.6. Anup Vijayan writes to us on Twitter. He wants to invest in Suzlon Energy with a long-term view. Anup wants to know if this is the right time to enter into this counter. Gaurang, I'll come to you and I know your answer, but I'll throw it to you. What would you want to advise our viewer?
Well, Navneet, I will never get tired answering these questions about Suzlon, and there are likes of other stocks as well. So, Anup, to be very honest, whether it is a short-term, medium-term or a long-term time horizon, I would not advise you to buy this stock from any angle whatsoever. And my advice is that the conventional wind power sector is now a history. Solar power is much more affordable. It is much more cheap. It is much more, cheaper in terms of maintenance. And more so, the per unit price of solar power compared to wind power is much, much lower for solar power than wind power now, thanks to the recent budgetary changes that the Honorable Finance Minister made in terms of solar panel and cells. There is no duty. So, and the most important point I would try to drive home is that this particular stock, Suzlon, is over-owned by a lot of investors, big and small. And any kind of an uptick in terms of higher level will be met with resistance, because people are tired and frustrated holding the stock and they would want to take an exit as soon as possible, ASAP. There are better stocks, better investment ideas that you can invest in. Case in point, I would give you 2 or 3 of them. DCB, Federal Bank, L&T Finance and Holding, and of course Ashok Leyland. You would be better off buying these stocks rather than buying Suzlon.
Gaurang, I'll have a question. You said Federal Bank and DCB, but both these banks, I guess they did disappoint with regard to Q3 earnings because of higher slippages, if I'm not wrong.
So I'm extremely positive. I mean, I don't look at 1 quarter, 2 quarter, and I would definitely agree with you. These are 1 of quarters of slippages or 2 of quarters of slippages. Not to forget, Federal Bank has come up from the levels of 65, 70. DCB Bank, Navneet, when we initiated the coverage, it was trading at sub 60 levels. And if I look at last 3 year, 4 year, earnings, I would definitely give credit to both these banks and treat the last 1 or 2 quarters as one-off with a visibility of improvement in the fourth quarter in the coming fiscal. Hence, we remain positive on both these names.
Okay, that's the view coming in from Gaurang. So you can ignore or avoid stocks like Suzlon. He's given some picks here: DCB, Federal, Ashok Leyland, and L&T Finance. These are the counters which Gaurang is bullish on. Well, we're getting a lot of your live queries on Facebook and Twitter. I'll go across to the Facebook queries first, and this one comes from Krishna Aditya. He wants to invest in IFP Agro with the long-term view. He wants to know if these are the correct levels for him to enter into this counter. Rakesh, if I can come to you, last 1 year, this counter has given you 80% returns. At 830, would you advise somebody to take a fresh bet?
Well, we have already seen a good levels coming in, but at current levels, I won't suggest buying at current levels from the long-term point of view. I feel one should wait for a decent correction before making an entry from a long-term point of view. If the view is long-term, then I would suggest buy Sundaram Finance at current levels, which is trading around 1973. And I'm expecting a good returns over here. My targets, 18-month targets are around 2350 to 2400 levels on the upside. If you want to buy anything fresh, then one should look at Sundaram Finance. I won't suggest buying the counter at current levels.
Okay, so Rakesh is advising not to buy at current levels on IFP Agro, but he does like Sundaram Finance at current levels, which is trading with cuts of almost 1% today. Okay, our next query for the day comes in from Varun Shetty, who has written to us on Facebook. He wants to invest in HCL Technologies with a 6-month view. He's asking if this is the right time to put his money. I'll take this query back to Rakesh since it's a 6-month view. Well, the numbers did come out today, which were pretty much in line. The management has maintained their revenue guidance. Rakesh, on the charts, I guess HCL Technologies is trading at its 52-week high. What would you recommend at these levels? Should one buy or they can ignore?
No, Navneet, I feel one should not ignore. Rather, one should buy at current levels, and on any decline to around 940, 935 levels, one should add. Like, I'm expecting a level of 1050, 1070 on the upside for HCL Tech in next 6 to 8 months, and these are the correct levels to buy into.
Okay, correct levels to buy into, in fact, is the advice from Rakesh on HCL Technologies, and counter which did come out with its earnings today. 959 is the level. It's trading with gains of 0.5%. Our next query for the day is from Priya Singh. She's bought 150 shares of HDFC Bank at 1845 for the 3-year view. She wants to know if she should hold or sell these shares. Gaurang, the numbers came just a while back, and I guess the press conference too will start in a while now. They never disappoint their shareholders or the analysts. They've been pretty much in line, consistent performance. Mild bit of uptick was seen, however, with regard to asset quality. Priya is pretty much in the money. 1845 is where she bought. She's got 3-year time period. What would you advise her?
Extend the time horizon if you really want to make the best of your investment. And these two twins, HDFC as well as HDFC Bank, as you rightly mentioned, Navneet, have never ever disappointed long-term investors. And I'm talking about the track history of 5-year, 10-year, or maybe more. And look at their performance. I think every time or every 2-3 quarters, they raise the bar of the performance. And my sense is that as we go forward, the environment will be more conducive for banking as well as NBFC, housing finance companies. That's where HDFC Bank and HDFC Limited will have a niche advantage and will outperform. So continue to hold on 3 years if you have the time horizon, but if you have the liberty to extend that time horizon, and if you have, if you're not in need of money by that time, then my sense is you are better off with 5-year, 6-year plus kind of.
Sure. Well, as we speak, we've got Kotak Mahindra Bank, the other private bank which has come out with its third quarter earnings. The numbers are being flashed here on your screen. The net profit for the quarter is up 20% at 1053. Remember, the Bloomberg estimate was around 1090. So just a bit of disappointment when it comes to the bottom line. It's just slightly below estimate, let me just tell you. Well, if you also look at the net interest income, that's coming at 2394 versus our estimate of 2427. So that's also a tad bit below estimate. estimate. But remember, the stock's reacting pretty positively post its numbers. It's in fact trading with gains of 1%. We'll get you some more details with regard to asset quality. The gross NPA, I guess, for the current quarter has come in at about 2.3%. That's being flashed here on your screen. Important to check what kind of loan growth was seen this time around from the bank, because that's the key metric. The NIMs, that'll be the other key metric which will be watched by the street. But clearly, the numbers do look pretty much in line. A slight bit of disappointment is there. Gaurang, if I can come to you on Kotak Mahindra Bank, what are you making of these initial numbers that we've received?
Well, again, this is also one of the mid-cap banks, if you will, private sector, which has actually outperformed Navneet. So one-off quarter should not deter your long-term investment time horizon or your, view. I would like to listen into the management in terms of the detailed commentary. But as a disclosure, we do have a positive coverage on Kotak Bank and as an investment idea, again, long-term.
And I guess the stock's reacting positively, Gaurang, because the asset quality sequentially seems to have improved. 2.31, as I told you, for the December quarter. And in the September quarter, GNPAs were at 2.47. So there is an improvement there. For net NPAs also, it's 1.09 versus 1.26, which was seen in the September quarter. So that asset quality number is looking good. Probably that's the reason why we are seeing that positive reaction on the stock, despite of the NI as well as the profit figure, which is come in below what the street was estimating. And even if you look at the absolute figure of the gross as well as the net NPA, if I compare it sequentially, it is lower. In fact, it is 13714 versus 3814. That's for the gross NPA. The net is 1727 versus 1918. The provisions for the quarter is 212 versus 216, which was there in the corresponding quarter. But let's go across to Shraddha to find out what are the key highlights from the numbers this time around, as we are flashing that the profit has actually beaten the estimate. Shraddha, is that true?
I have the numbers, Navneet. So yes, I'll just start off with repeating some basic numbers. Net interest income has come in at 2394 crores versus the number of 2427, broadly in line with what we were expecting. And net profit has come in at 1053 crores versus the number of 1090 that the Bloomberg estimate threw up. So a marginal miss coming in there. The key here is that the net interest margins have fallen, come off sharply, not sharply, but by about 10 basis points, so down to 4.2% versus 4.3% sort of a number on a sequential basis. Now, we were expecting loan growth to come in at about 21%. 21% is what the loan growth came in at in Q2, so we expected that trend to continue. So advances growth has come in at 23%. So again, as far as the business growth momentum is concerned, that has also been maintained. Now, as far as the gross NPA numbers are concerned, the number has come in at 2.31% as compared to 2.47%. So it has actually declined on a sequential basis. So that's the good part. I haven't yet gotten any updates if they have disclosed any sort of divergence number or the outcome of the RBI audit in their notes to accounts. I'm trying to get that. But as far as the restructured loans are concerned that are considered standard, they have come in at 67 crores. So again, broadly steady at the levels that they were in the last quarter. SMA2 outstanding has risen to about 0.19% of the advances from 0.16%. So at least based on the data that I have, the numbers seem to be in line, PAT slightly lower than what you were expecting, but as far as the asset quality trend is concerned, it seems to be in line. No worries that I can at least see from the first glance at the numbers, Navneet.
Right, Shraddha, and apologies for throwing that googly at you. The profits are not above the street estimate. I think by mistake we put out that topic,
right,
but it is below what Shraddha's estimate was. And what she highlighted was that the asset quality has improved. Shraddha, I've just opened the press release. The NIMs are at 4.2. Are they in line with what the street was estimating?
Yes, like I mentioned, Navneet, 10 basis points lower at 4.3%, versus 4.3%. So I'm assuming there could have been some pressure on the yields, but again, it's given that the CASA traction continues, 4.2% would not really be taken very negatively also.
Okay, so net, the numbers are looking good. Let's go across to Mr. R. Sri Shankar, head of Institutional Equities at Prabhudas Leeladhar, who's joining us on the phone line. Sir, good afternoon and thanks a lot for joining us. What are you making of the initial numbers that we've received of Kotak Mahindra Bank? They do seem to be pretty much in line, though the NII and the PAT figure is below what the Bloomberg estimate was throwing around, but definitely there's an improvement with regard to asset quality on sequential basis.
Yeah, very much on track. I would say that a slight here or there. Our estimated quarterly numbers in terms of PPOP was around 1,845 crores and a net of 1,073. That has been our estimate. So it's more or less around that number, slightly here or there. So I would say I would rather wait for the conference call to hear from the management before making any more comments on it. Otherwise, it has been more or less on line.
Mr. Srishankar, your comments on the net interest margins which have come in at about 4.2, because I think that's a key metric to be watched out in banking numbers. Have that disappointed you?
Not really. One of the reasons is we have been anticipating that this quarter, you're going to see definitely a problem for the banks from three angles. One angle is you probably will see lesser investment income or a treasury profits from most of the banks. Second, your cost of deposits or the yields were not moving up at all, and the yields were coming under pressure. So the yields under pressure would have resulted in a certain amount of pressure coming onto your margins as well, and that's being reflected here. You saw it even in Yes Bank, and if you have gone and look back into Federal, South Indian, you have seen it over there. So everywhere we are actually seeing some kind of a pressure which has been coming on. Plus, as I mentioned about the treasury also would not have contributed big time. There will be some impact from that side. So I would rather say it's lined with expectations.
All right, this is Shraddha here. I just wanted to understand, your view with respect to the gross NPA number that has come down from about 2.5% or so to 2.3%, 2.47% to 2.3%. What do you believe could have led to this decline of the gross NPA number on the sequential basis?
See, let's not look into this in terms of percentage basis. My percentage will go down if my denominator actually increases. My loan growth is higher, and if that number is higher, then percentage terms it could become lower. Let's even look at an absolute number and overall guidance that bank has given for the next 1 year. So I would think that in some quarters it could be slightly here or there kind of scenario. But again, I would think it is in line with the direction that the bank has given. So I don't think there is anything to be surprised of.
Okay. And Ashutosh, just wanted to ask you for your closing comments with respect to the what you're really watching out for from the management press conference, because they haven't really disclosed or given anything with respect to the RBI divergence in their notes. So either they have none or they're probably going to talk about it in the press conference. I don't know. But any other important thing that you're going to be watching out for, or any clarity that you require?
RBI divergence in the last quarter itself, they have stated that they have not received the report from the RBI, and the divergence need not be disclosed. So that divergence is below 15% for them. So that already has been disclosed by the Kotak Mahindra Bank's management in the last quarter's analyst call. So there is no surprise on a divergence front from the Kotak Mahindra Bank side. Okay,
fair enough. And lastly, your call on the stock after the numbers?
See, we will take a call after post the results, but definitely the financial service subsidiary of the Kotak Mahindra Banks are doing quite well. Apart from the core business of the banking is growing at a very rapid pace. So we clearly see this as a very good franchise. Currently we have a buy rating, and we will revisit our price target post the analyst call.
Thank you for joining us, gentlemen. A good and in-line set of numbers from Kotak Bank. Navneet, over to you.
Thanks, Shraddha. And well, it's turning out to be an earnings-heavy Friday, because we've also got ITC numbers flashing there on your screen. We'll just get those numbers. The revenues are at 9,950 versus Bloomberg estimate of 10,608. So the revenues are below estimate. The stock seems to be reacting positively. The profit figure has come in at 3,090 versus our estimate of 2,830. That's a big beat when it comes to the bottom line. We'll just check if there is any sort of exceptional item there which has bumped up the bottom line this time around. Remember, the key thing to be watched out in ITC's numbers are the cigarette volume growth. And this time around, the street was factoring in that there would be a degrowth degrowth because we've also seen the company increasing the cigarette prices. In fact, this is not post-GST, but the pre-GST era. Remember, they started increasing the price. And if I'm not mistaken, in the quarter gone by, the cigarette price increase was almost 14 to 15%. One factor which is heavily impacted ITC's stock price movement after GST tinkering was that now the volume growth will be even more lower because more and more they're getting dependent on increasing the prices, which the street does not take it that positively, especially the analysts who are tracking this counter. And remember, also watch out for the cigarette EBIT. That's a very, very key number to be watched out in ITC. And let's look at the other segment. Why I'm saying cigarette is important. Remember, 50% of the top line and almost 80 to 90% of the bottom line comes from this space. But the other segments, which are actually our hotel, there is an expectation that there could be a bit of improvement from this space because we've seen the occupancy rates going up. Agri is expected to do well because of rise in commodity prices, and paper, let's not forget, the paper stock's been going up in the last few months. So paper business, because of increase in prices, that too is expected to do well. We'll just get you the analyst take on it and what exactly the numbers are throwing about. As of now, I can tell you the top line is below what the street was estimating and the bottom line is above. So I don't know if there is any sort of exceptional item which is coming or not. We'll also get you what the EBITDA margins stand, but as of now the numbers are looking okay. And remember, this is the counter which actually trades at a discount, not actually a discount, but the valuations are considered to be it's trading actually at 25 times its FY19 or FY20 earnings, and as if you compare it to HUL, that's almost 49 to 50. Let me get your analyst view. Sameer Deshmukh, senior analyst of FMCG of Reliance Industries, joins us now. Sameer, thanks a lot for joining us. What are you making of the key numbers that we've got from ITC this time around?
Yeah, the first number to look at is the cigarette volumes. I believe that the cigarette volume decline has been lower compared to what we have seen in the last quarter. Last quarter, we have seen around 6 to 7% drop in cigarette volumes. I think this time around, the drop is restricted to around 3 to 4%. And secondly, in terms of growth in the core cigarette EBIT, there has been a 8% growth in the EBIT, which is again relatively better compared to 2% growth which we saw in the last quarter. And as you mentioned earlier, that the overall revenue growth has come slightly lower than expectation, but that is not because of the cigarettes business. I believe that is more due to the agri business and the paperboard business, where the revenues have come in lower.
Sameer, if I'm not wrong, the prices in the previous quarter, they'd increased by almost around... Okay, before we get to that, we're flashing the margins on the screen, which is 40% versus 38.3, which was seen in the corresponding quarter. If these numbers are to go by, Sameer, I think on an operational front, the numbers are looking good.
Yeah, on the operational side, especially if I'm looking only at the cigarettes business, then the numbers are really good. And even in the non-cigarette FMCG business, they have turned around from a loss of 20 crores to a profit of around 47 crores. It's only the agri business where the segmental profits are relatively muted. Apart from that, cigarettes, FMCG, and paperboard business have actually shown good results.
The non-cigarette FMCG would also be doing well because of a low base. That clear impact was seen in HUL's numbers. Please stay on with us. I'm just going to go across to Darshan Mehta to find out more details of ITC's number. Darshan, over to you.
Yeah, so Navneet, if you're looking at it, doesn't seem the most impressive numbers from ITC. First of all, if you're looking at it, the revenues, when we were expecting a revenue of more, say, net sales of more than 10,000 crores, it's come slightly below. It's 9,700 crores. So there's almost a 1,000 crore miss as far as the top line is concerned. Secondly, if you're looking at it, EBITDA has also come in lower. In fact, it's the same thing. So EBITDA, we were anticipating 3825 crores. It's come in close to 3,900 crores. And that is why, since the EBITDA has increased and the revenues have actually come in lower than what was anticipating, that is why this EBITDA margin of 40% looks elevated. Profits are pretty much in line, 2,800 crores versus close to 3,000 crores. Now, if I'm just looking at the breakup, cigarette revenues are down almost 50%. 40%, but probably we'll need to factor in the excise as well as GST impact in this. The other FMCG revenues have done pretty much well, 2,800 crores versus 2,500 crores. Hotels has done well, the agri-business has come off, and the paperboard. So on the top line, the revenue growth, as much as we were anticipating, has pretty much not come in. So as of now, if you can say, it's not the best of numbers.
Right.
It's a pretty much inline set of numbers that
Darshan,
ITC has come
I'll
out.
just like to clarify there, I don't think the segmental numbers we can compare it, because remember in the corresponding quarter that excise duty figure is there, but this time it is net GST.
Yes.
So probably those numbers are not comparable. What I want to compare is the EBIT of the cigarette. So that's 3,269 for current quarter versus 3,033 which was there in the corresponding quarter. So the EBIT has definitely gone up, but I think we'll have to adjust the excise numbers. And remember, this is a company where excise duty numbers were pretty much on the higher side. So the EBIT from cigarette has gone up. From hotels, it's 54 versus 42. Agri, 233 versus 236. Paper boats, 268 versus 246. Sameer, I'm coming back to you with regard to cigarette EBIT number, 3,269 versus 3,033. I think it's largely on back of price hike.
Yes, it is largely on the back of price hike, and what is happening, there is a shift which is happening in the mix as well. So the lower end of the cigarettes are growing at a much faster rate compared to the regular premium regular segment. And even if you look on a quarter-on-quarter basis, the profits from the cigarettes business have been relatively stable. So even in the September quarter, they did around 30-91 crores. This time it's around 30-70 odd crores. So I don't think the numbers are that bad. Obviously, there is a concern with respect to the excise, which could be levied on cigarette in the forthcoming budget. And one should not forget that if looking at the overall net profit is also higher because there's a one-off, I think, of around 100 and 400.
Coming to that, Sameer, there is an exceptional item which has been reported of 413 crore. Probably that's the reason why we are seeing that profit figure showing a beat this time around vis-a-vis our estimate. Sameer, anything else you want to add?
No, in case of ITC, that 413 crores is basically because of the entry tax in Tamil Nadu, which has been converted back. But I think going forward, the key monitorable or key thing to look at will be how the excise and the GST regime works out for ITC in the forthcoming budget. Because that will be the key thing to watch out.
Okay, Sameer, we'll leave it at that. No, thanks a lot for joining us. And I guess the HDFC Bank press conference is going to just start in a while, so we'll be cutting into it. But, okay, we'll cut into it.
3 crores, which was an increase of 23.9% over the corresponding quarter of December 2016. If you look at the breakup of this these net revenues, roughly 73% is net interest income and 27% is the other income. Net interest income for the quarter was 10,314 crores, and NII growth was 24.1%. The core net interest margin for the quarter was 4.3%. Other income, which was 27% of net revenues, grew from 3,142 crores to 3,869 crores, and that was a growth of 23.1%. If you look at the breakup of that other income, there are typically 4 components, and the largest component, which is of that 3,142 of total other income, 2,872 of the 3,314,2206 and of the 3,869,2872 was fees and commissions, and fees and commissions for the quarter on a year-on-year basis grew by 30.1%. Operating expenses for the quarter were 5,732 crores, which represented an increase of 18.4%, and what that meant that the core cost to income ratio was at 41.2% as against 43.8% in the corresponding quarter of last year. So both on the revenue growth side as well as on the cost side, in terms of the cost to income, you've seen that there has been an improvement on a year-on-year basis. Total provisions were at 1,351 crores as against 715.8 crores for the December 2016 quarter, and as against 1,476 crores for the September quarter. So on a sequential basis, they are marginally down. On a year-on-year basis, of course, there is an increase. Moving on, if you look at post-tax, the net profit growth, of course, was 20.1%, and the actual net profit for the quarter was 4,642.6 crores. A couple of the balance sheet items as well. The total balance sheet size as of December 2017 was 9,49,000 crores as against 8,28,000 crores in December of 2016. Total deposits were at 6,99,000 crores, an increase of 10.1% over December 2016. The CASA deposits grew by 6.7% on a year-on-year basis, and however, on a sequential basis, it would be about 3.9%. Remember, both for deposits and for advances, the base is a little distorted, because if you remember, December 2016, which was the demonetization quarter, saw a huge spike in deposits while loan growth came off. So you'll find that the loan growth looks particularly strong. Total advances growth at 27.5%, which took the total advances to 6,31,215 crores. However, I think therefore if you look at sequential growth, which might be a little more relevant, the sequential growth in advances was 4.4%, and as I mentioned earlier, the sequential growth in deposits was again at 3.9%. The CASA ratio was at 43.9%. The loan growth itself came equally strongly from both wholesale and retail. The mix today is now 55% retail and 45% wholesale. And again, if you look at it from a regulatory classification in terms of the Basel II classification, then retail loans grew by 28% and wholesale by 26%. If you look at it from a business perspective, our own internal business classification, the growth was 29% retail and 24% wholesale. So either which way, no matter how you cut it, both those businesses have, both those segments have contributed to the loan growth. For the 9 months, the bank earned a total income of 69,912 crores as against 60,041 crores for the 9 months ended December 2016. Net revenue growth was 22.8% for 9 months, and net profit growth was 20.2% to 12,687 crores. Finally, on network and asset quality, as of December 2017, the bank's distribution network was at 4,734 branches and 12,333 ATMs across 2,672 cities and towns. 52% of these branches are in semi-urban and rural areas. On the asset quality front, gross NPLs were at 1.29% and net NPAs were at 0.4%, and our total capital adequacy based on the Basel III guidelines was at 15.5%, of which Tier 1 was at 13.6%. Those are some of the key financials, and if you have any questions, I'll be happy to take them.
So on the divergence, you've given more data. Last time you had said that there was some discussion about one account. Now you're talking about 3 accounts. So is there a fresh assessment?
No. So of the divergence which was there, first of all, as you know, as of the last quarter, we had mentioned that while there was no finality to that, we had already made contingent provisions. Immediately thereafter, that account had been declared an NPL. Of the balance amount, some had already been declared NPL in the June quarter and the September quarter. So as we stand, I think we have now given the total, since this was a quarter in which this is the first quarter end after the finality to that, we have given the divergence of the total NPLs and of course what the status is on each of these.
Okay. The last account, I mean the account which you had declared in the last quarter where the discussion was going on, I mean other banks are saying that it's paying for a year. So will you write back that provision?
Well, as I've said, we have mentioned in that note itself, the account has been upgraded by the JLF itself. As far as provisions are concerned, well, whatever portions of the provisions were floating provisions have gone back to floating, and the rest back to other contingent and general provisions. Yeah, whatever the amount in respect of that would be.
We just want to get a sense, because you spoke about the year ago number not being relevant. Only on lending growth, April, December, what kind of year to date, what kind of growth have you shown? Also in terms of, because you mentioned the divergent account, what were the criteria on which there were, as in the RBI spotted divergence? Is it because it's standard with you and not with somebody else? Is it because there was some decision making at a group level that is not happening? We just try to get a sense of it, because generally you've not had divergences.
Yeah. So I think this is again something which we had partially explained last time as well. This was an account which was subject to the flexible structuring under the 525 framework, and in respect of that, the regulation, the supervisory communication was that they felt that was not sort of meeting all the regulatory guidelines, and therefore that flexible structuring amounted to restructuring, and which therefore declared an NPA. From a servicing perspective, the account had not been past 90 days, which was the accounting reality.
Also, the bank is looking to raise close to.
Sorry, yeah, on the loan growth piece, see, I think all I'm saying is that because of that distortion, which of course corrected itself along the way, just the number seems inflated. But if you look at it in terms of the absolute growth that we've seen for the last 3 quarters, we've still seen very strong, growth. And you'll find that the corrected year-on-year growth will get reflected if you look at just the September quarter, or hopefully the March quarter as well. It's just that this particular quarter, because you had that flow, and by the time you had the March quarter, some of the spike in deposits had normalized, or at least some part of that. And again, that part of the loans, that part of it which had come down because people had prepaid or repaid their cash into their, the SME lending and the business banking lending, that got corrected along the way. So I would still say that if you look at the last couple of quarters, we've had most of the businesses growing their loan book somewhere in the high teens or low 20s. And I think this distortion is just a little bit of a base effect. But sequential momentum again at 4-ish% is still 4.5% is pretty strong.
All right, that's Paresh Suktankar of HDFC Bank giving out the details of their numbers. The headline numbers are along expected lines. You've got net profit growth at about 20-odd%. Net interest income growth is at 24%. So no, large or unexpected movement there. What is unexpected, especially for HDFC Bank, which is a pristine asset quality bank, is the divergence in bad loan reporting, which the bank has now disclosed as part of its numbers. Paresh was talking about that, but the numbers are what had been identified by the bank, and remember, these are FY17 numbers. So as of 31st March FY17, the bank had reported bad loans of 5,885 crore. The RBI identified this number at 7,937 crore. The resultant divergence of 2,051 crore is above the 15% mark. The RBI guidelines say that if your divergence is more than 15% of your reported NPA, then you have to disclose it. So HDFC Bank has had to disclose it. 3 accounts. Earlier they had indicated that there may be a divergence in 1 account. It is now 3 accounts. One of those accounts, which is widely believed to be the JSPL account, the issue was a structuring of the 525 restructuring scheme, and the Reserve Bank of India had raised some issues. Paresh just said that those issues have now been rectified and the account has been upgraded. Just to give you a sense that HDFC Bank is not alone. Private banks have been reporting divergences. Public sector banks reported a large chunk of their divergences in FY16. FY17 has been the year when private banks have reported divergences. So in HDFC Bank's case, it's a 35-odd% divergence. In Axis Bank's case, it was a 26% divergence over the reported number. ICICI Bank has not yet disclosed its divergence. Yes Bank was the starkest of them all. Of course, last quarter when they reported their numbers, they disclosed a 6,355 crore divergence, which was 314% of the reported NPA. IndusInd Bank also has not yet disclosed. So those are the HDFC Bank numbers. Apart from that divergence issues, par for course and strong numbers on the net interest income and net profit and advances growth front.
Interesting that the divergence really hogging the headlines today. The other private bank that reported numbers today is Kotak Mahindra. It managed to meet street expectations, some marginal improvement in asset quality. Stock is up marginally today. Shraddha is standing by with the fine print on Kotak Bank.
Well, you were just talking about the divergence issue. So I just want to highlight that at least so far Kotak Bank does stand out because they haven't, in fact, in the second quarter itself, they had said that there is no need for them to disclose the divergence numbers based on the RBI audit, which means that their divergence is less than 15% because that's what the RBI rule says. You have to disclose only if the difference is more than 15%. That means it is much lower. In terms of the numbers, like you said, they're broadly in line. In fact, the net interest income has come in at 2394 crores versus the expected number of 2427. Net profit has grown by about 23%. It has come in at 1053 crores versus the number of 1090 crore based on the Bloomberg consensus. So a miss of about 1.5 to 2%, but I would broadly go with in line for that. Net interest margins have come down by about 10 basis points to 4.2% versus 4.3%. If we look at the asset quality, the gross NPA number has improved, in fact, to 2.3% versus 2.5% on a sequential basis. So that's one trend that we are seeing which sets it apart from some of the other banks. CASA ratio continues to remain strong at 46.7%, but again, it has come off by about 100 basis points or so on a sequential basis. Loan growth traction has been maintained. So loan growth in the second quarter came in at about 21%, this quarter at 23%. So broadly, the numbers seem to be good and in line with what the street was expecting. No negative surprises for Kotak Bank at least.
All right, Shraddha, thanks so much for that. Those are the two bank numbers, but there's a whole host of other numbers. HCL Technologies reported muted growth in profit in line with analyst expectations and maintained its guidance for the current financial year. Agam Vakil was at the HCL Technologies headquarters in Delhi this morning. He wraps up the key takeaways on that company's earnings.
Well, it's a steady quarter for HCL Technologies in line with Bloomberg consensus estimates. Starting off with the top line, we did see it move up by as much as 3% at a little over 12,800 crores. And with margins coming in at around 19.5%, its profits also grew at around 2,195 crores. In terms of guidance, the management has maintained the FY18 revenue guidance at around 10.5 to 12.5% on a constant currency basis, and margins at around 19.5 to 20.5. What stood out for this particular quarter was the performance as far as engineering and R&D services concerned, which saw about a 13.6% sequential growth on constant currency terms. On the other hand, we did see continued slackness when it comes to the infrastructure services, which saw a decline of around 1.2%. Financial services did stand out, where we saw about a 1.4% growth. But on the whole, in terms of some other verticals, is the retail vertical, which also took up quite a bit and moved up by as much as 6.6% sequentially. On the whole, a steady quarter, largely in line with Bloomberg consensus estimates.
Steady quarter for HCL Tech. Agam also caught up with the management of the company, Vijay Kumar, President and CEO, Anil Chanana, CFO at HCL Tech, to understand what's the likely drivers of growth in the coming quarters. Listen.
Engineering services has been one of our strongest service lines for several years. And this quarter, if you really dissect our performance, there are two elements which has really caused a significant outperformance. Right. We have an offering called Geometric PLM. Yes. Which actually was a part of the acquisition that we did with Geometric. We won several deals. All of them got executed in the PLM services space. So that's one big contributor. Second is we continue to invest in inorganic strategies, right, like IP partnerships, and that's also contributed a good number to the growth. Right. And all of this is also helping the core business of engineering services, because there are professional services, there are a lot of add-on services which you can look at in the engineering services due to the IP partnership and the engagement that we have with our technology partners.
Right. CVK, as you may imagine, there will be concerns with respect to infrastructure services. We continue to see some slackness there, and there has been a lot of talk about delay in decision making. My question then is, what do you make of clients and their conversations? What's going on right now?
Yeah, I think, see, infrastructure services, the fundamental driver for growth has always been large ITO deals.
Right.
And last year or towards the end of 2016 and most parts of 2017, large ITO decisions were getting delayed due to change in the political environment. There was a hold pattern for some time. And last quarter, I said we are seeing that change. So in the past quarter, we signed a very large infrastructure services deal for a consumer goods company. And we do expect it to continue. And once you sign the deals, for it to demonstrate or move into revenues, it takes at least 3 to 4 months.
Right.
So we remain positive on our booking. In fact, this quarter, the past quarter, we had the highest booking, the total highest booking for the past 12 quarters.
Right.
So we are optimistic. Infrastructure services specifically, as I said, we expect to get to a good growth in FY19.
Right.
I think you should give us a couple of more quarters before you expect good growth in infrastructure.
In terms of growth, again, I've been reading about reports which suggest that growth for HCL Technologies is going to be largely back-ended. That is coming in the second half of the financial year. If you could give us a little more about whether or not you can expect that growth to come back in the final quarter of this financial year.
Yeah, but whatever we grow, whatever growth we deliver in the last quarter is going to make a very little difference so far as the overall full year number is concerned.
Right.
So we do believe that we will continue to be at the lower end of the guided range, which is 10.5 to 12.5.
Okay. All right.
Yeah, but as Vijay explained, the deal wins which we had, I think they give us a good visibility into moving into FY19.
Okay. All right. Great. So my next question was to do with financial services. Again, in comparison to some of the other listed peers, where HCL Technologies has done slightly better, but what's going on here with respect to the contracts and the deals? Because is this more about transforming business, and in comparison, what kind of traction are you seeing from traditional services?
See, our financial services has been a great several quarters of performance.
Right.
If you look at our CQGR for the last 6 quarters, it's all about 3% in financial services. And what is it? Which means it is not just a one-off. There is a systematic way we are continuing to grow, and there is something validates the differentiated strategy there. Financial services, all large financial services firms continue to reduce their spend in the traditional areas,
right,
and reinvest that into digital solutions, building a completely new stack based on OpenStack and some of the new technology stacks that are available. And we are very strongly participating in the transformation in this financial services organizations.
Right.
I think that's in my view, the single biggest element. The second element is even on the traditional spend. While there is a lot of expectation on what automation can bring, we have delivered significant cost savings for our customers, driven by our automation platform, which is Dry Ice.
Right.
And that's also resonating very well and help us win some of the traditional businesses as well,
yes,
which the current incumbents are not able to deliver that level of optimization. We've been able to do it through Dry Ice. And that's also opened up a couple of pretty large financial services firms in continental Europe.
Right.
So this gives us, while the last 6 quarters has been good, we continue to feel positive about how this can change in the next few quarters as well.
All right, that's HCL Technologies. Let's move on to ITC. The company has managed to meet estimates in the third quarter, driven by the FMCG and hotels divisions. But Darshan Mehta has a closer look at the numbers. Darshan.
Yeah, so if you're looking at the top line growth, the net sales, if you exclude the excise duty, the growth has been 6%. It's come in slightly lower than what we were anticipating. We were anticipating almost 1,600 crores. It's come in at almost 9,800 crores. So that's a substantial miss as far as top line is concerned. As far as the profit is concerned, it's grown by almost 17%. But remember, there is an exceptional gain of 413 crores because of a Tamil Nadu tax write-back that has come in. Margins, EBITDA is up almost 10% at 3,900 crores. We were anticipating 3,825 crores. So EBITDA is coming in line with what we were anticipating. And because of the profit growing 6% and the EBITDA growing much by 10%, the margins look inflated at 40%. Now, if you're looking at it, the segmental revenues are not comparable, given the fact that this time around there was GST implementation that was there. But if you do an EBIT to EBIT comparison of what we did last time around. The cigarette EBIT has come in at almost 3,250 crores versus 33,000 crores. It seems that most of it will be on account of the price increase. We don't know yet what the volume impact is, whether there is a volume increase or a decline. But FMCG EBIT has moved to a positive this time around. That is positive. The hotel EBIT has also done well. The paper as well as the agri EBIT have been rather stable this time around. But overall, if you take a look at the whole numbers as such, it's a pretty inline performance. No major surprises coming in from ITC.
Okay, that's ITC for you. Thanks, Darshan, for that. Let's talk about Airtel. The going's only going to get tougher for Airtel. The country's largest telecom operator failed to meet street expectations in the third quarter. Average revenue per user, or ARPU, falling for the sixth straight quarter. Somit is here with some details. Anything that stood out, Somit, this quarter?
Well, there are a few things, but I'll talk about it later. So Bharti Airtel reported a weak set of numbers, but operationally they still managed to hold on because of the cost-saving initiatives that the company took in this quarter. Now, the numbers were below analyst estimates. Revenue was down by around 7% to 20,319 crore rupees, while EBITDA was also down by around 6% to 7,469 crore rupees. Now, this EBITDA number of 7,469 crore rupees was the lowest in the last 15 quarters. Now, if you see margin, however, expanded marginally to 36.8%. However, net profit was down by around 11% to 306 crore rupees. Now, the key number for the telecom service provider, that is ARPU, average revenue per user, for the third quarter came in at around 123 rupees, which was 15% down compared to the last quarter. Now, this is the lowest ever ARPU that the company has reported, and this is the sixth consecutive quarter where the ARPU has fallen. And also, this ARPU is down because of the 57% cut in the interconnect usage charges. Now, if you see the revenue and net profit trend, the revenue of the company has been falling for the sixth consecutive quarter, and in this quarter it was down by around 7%. Now, this is because of three reasons. First is the 57% cut in IOC, second is ARPU down trading, and third is the competitive intensity that Jio brought in. Now, the similar trend was seen in the net profit also, where it fell for the sixth consecutive quarter, and this quarter it was down by around 11%. Now, one thing to cheer for Airtel was the African business, which is paying off and saving the Indian wireless business. Now, you can clearly see here how the EBITDA margins of India mobile business has fallen from 40% to 33%, while that of Africa business has come up from the lows of 22% to 35.5%, and this is the highest ever EBITDA margin reported by the Africa business of Bharti Airtel. Now, because of heightened capex and competitive intensity, the company's leverage ratio, that is net debt to EBITDA, is also at its highest point of 3.01 times, the highest ever that the company has reported till now. Now, lastly, the key theme, that is data consumption. Now, this is not a financial parameter, but an important one to watch out for given the current market scenario. Now, in the third quarter of financial year 2018, the data consumption stood per customer per month stood at 5.3 GB. Now, this is not a big jump that the company has seen in the previous quarter, where from 1.3 went to 2.6, and from 2.6 it went to 4.1. And also, this number is below what Reliance Jio customer uses. Now, Reliance Jio customer used around 9.6 GB of data per month in the last quarter.
All right, Sumit, that's Airtel. Now, Jio's numbers will come out possibly as part of the Reliance Industries numbers today, and they may report a profit. What's the expectation from RIL, both telecom and beyond that?
So, if you see on a standalone basis for Reliance Industries compared to last quarter, revenue is expected to be up by around 11% to 76,000 crore rupees. EBITDA would be marginally down to 12,876 crore rupees. Margins would also be down by around 200 basis points to 16.9%. However, net profit would be marginally up by 1% to 8,345 crore rupees. Now, this will be the seventh consecutive quarter where the Reliance Industries on a standalone basis will be seeing its net profit grow. Now, the key number, that is gross refining margin, is expected to come in at $11.5 per barrel for the third quarter. Now, this is a bit off when you compare it with the last quarter, where the company reported a GRM of around $12 per barrel. Now, this is because this Asian benchmark, that is the Singapore gross refining margin, has also come down to $7.2 per barrel versus $8.3 per barrel in the last quarter. So, if you see on a net basis, the premium to Singapore gross refining margin is actually bouncing back to $4.3 per barrel versus $3.7 per barrel in the last quarter. Now, in this quarter also, the petchem business is expected to outperform and offset the subdued refining segment performance. Now, petchem is expected to outperform because of volume expansion and because of the ethane imports that the company has seen in this quarter. Now, volume expansion is because this quarter will see the full benefits of the paraxylene plant that the company had set up. Lastly, Reliance Jio is expected to post a net profit in this quarter, which will also increase the consolidated net profit of Reliance Industries. Now, mainly it is posting a net profit because of the sharp cut in interconnect usage charges. Now, interconnect usage charges were cut by around 57% in the last quarter, in Q3 in fact. So if you see in the last quarter, the company had paid an IUC of around 2,100 crore rupees. So if we even assume that everything else remains same, a 57% cost saving could definitely see Reliance Jio giving a net profit number this quarter.
Sumit, thank you for that. Let's move on now. Markets have been keenly watching everything from the fiscal deficit to a possible return of long-term capital gains tax in the upcoming budget. But business is as usual, and Indian markets will continue to rally in sync with global markets. That's the view of market veterans Hiren Ved and Saurabh Mukherjee, even though Indian markets are expensive. They spoke to us earlier today. Here's a slice of that conversation.
If it's business as usual, then the baton would move to what's happening. We are in some sort of a synchronized global rally, right? So it'll depend on what's happening, globally. And obviously within that context, what's happening to earnings in India. So we are seeing reasonably good earnings coming through in some of the early names that we've seen so far. But the market already anticipated some of that, well in advance. So I think if the global bull market rally continues, then we will play in sync with that. I mean, I don't think we will do anything different. And maybe then the budget turns out to be one more event where it, where they say, it climbs another wall of worry and reaches a new high. And then whenever it has to eventually correct, it will. So yeah, I mean, I think people will forget it after maybe a week or so, or even shorter than
nowadays, maybe the next day. Saurabh, if I'm not wrong, and the last interaction that we had, you were not too constructive on the markets. I think the markets as of now are trading above what was your fair valuation for calendar year 18, if I'm not wrong. Now, what's the stance now? Again, assuming that the budget turns out to be a non-event, and no bad news is probably good news.
I think Jeremy Grantham of GMO said it very nicely on 3rd January. He says we're in a global meltdown.
Yeah.
So I don't think people like me and my views on valuation matter anymore.
That's okay. I like it.
So valuations clearly have nothing to do with reality. If you look either Nifty, Sensex, you're at 23, 24 times. You're 2 standard deviations above your 10-year average. There is no rational basis on which you can justify, not just our market, S&P 500 I think is in similar territory, highest S&P 500, most expensive since 1929, our market most expensive since I think 2000. So across the world, as Hiren is saying, as Mr. Grantham has said, we're in a melt-up, we're in a synchronized global recovery. So yes, I think the market's overvalued, but that doesn't really matter. I think what matters is confidence, which there's plenty of. What also matters is there a recovery happening in our country? And the answer in that is unquestionably yes. We are especially on discretionary consumption, especially on sectors like metals, on construction. You can clearly see the recovery panning out. You can see corporate confidence, consumer confidence improving. So that will drive even more animal spirits in the stock market. Because as it is, you're bullish, you've made money in the last 2 years. Around you, you see earnings growth improving, GDP growth improving. You don't really kill yourself trying to calculate the PE multiple and comparing to the 10-year average. You just say, let's party.
Yeah, well, Grantham also said that for a US investor, while the melt-up is on, if you think in US is expensive, go and buy the emerging markets, right? In the same piece,
there you go.
He was very bullish on the emerging market pack.
I don't think I've seen my foreign clients so happy in last 10 years. Because globally they are making money, I think it's the first sort of signs of, first big set of smiles I've seen amongst our foreign clients since the Lehman tragedy a decade ago. It's a remarkable time. It's a remarkable time. It's the first sign of real frenzy and complete bullishness taking hold of both global and Indian equity markets.
All right, we'll slip into a quick break, come back on the other side, get you the latest from the GST Council meeting that happened yesterday, all the goods and services that have been impacted by that meeting coming up.
हमारे पड़ोसी मेहताज हॉलिडे के लिए अब्रॉड गए हैं। हम कब जाएंगे?
उसके लिए पैसे कहाँ से आएंगे?
लेकिन मिट्ठू इन्वेस्ट और उस पर इन शुक्ला जी की जिम्मेदारी छोड़ गए हमारे सर।
एफडीज में इन्वेस्ट करूँ क्या?
अरे मिट्ठू जी, आज के जमाने में इन्फ्लेशन के बाद एफडी रिटर्न से हाथ में क्या बचता है? ईटीएफ में इन्वेस्ट कीजिए, जिससे लॉन्ग टर्म में मिलते हैं स्टॉक मार्केट जैसे हायर रिटर्न्स, यानी इन्फ्लेशन का कम असर।
लेकिन स्टॉक मार्केट तो ऊपर नीचे होता ही रहता है।
ईटीएफ लॉन्ग टर्म इन्वेस्टमेंट के लिए बिल्कुल उपयुक्त है। ये देखिए, हायर रिटर्न्स, इन्फ्लेशन बीटर एंड नो टैक्सेस। ईटीएफ में निवेश कीजिए और देखिए हाथ में कितना बचता है। भाभी जी, जरा कोकोनट ऑयल देना।
ETF investments are subject to market risks. Read all scheme-related documents carefully.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
What do we want from our country today? From the economy, from the politicians, the policymakers?
Do we want a better deal?
Maybe more perks for smaller businesses or large businesses or any businesses.
Do we want it to be easier to create something new?
To find the job of our dreams, to create jobs for dreamers.
Do we want growth? Not just for the sake of growth, but for what it represents.
Not just numbers on a graph somewhere, but prosperity that we can see, touch, feel.
These things we want.
Can we expect them realistically?
It's time. Time for us to accept less and expect more.
Time for us to get on the path to confidence once again.
Time to go from making promises to keeping them.
From manufacturing slogans
to really making it in India.
From a promising economy
to a delivering economy.
Can this budget mark a return to confidence?
Watch Budget 2018 with Bloomberg Quint.
Back online is the headlines at this hour. Markets look set to post seven straight weekly gains as corporate earnings meet expectations.
Emerging markets have peaked, says Jonathan Garner of Morgan Stanley. The Asia strategist tells Bloomberg that foreign inflows are bound to fall in 2018.
The GST Council revises rates for 29 goods and 53 services, also mulls simpler return filings.
And Singapore Stock Exchange's plans to introduce single stock futures gives NSE cold feet. The country's largest equity exchange fears a sharp drop in volumes.
All right, quick check on how the markets are faring at this point in time. We're seeing the Sensex and the Nifty pretty much where they began the day at 10,831, 14 points marginally. Some of these individual stocks where you saw earnings have reacted quite positively. ITC, for example, you did see the stock go up significantly after numbers came in, but it stabilized about 0.7% in the green today. Other banking counters, Kotak, HDFC Bank, these are stocks that have reacted to earnings announcements as well. 0.5% up on Kotak Bank, HDFC Bank on the back of that divergence announcement that came in of about 2,000 crore is trading about 0.7% in the green as well. The mid caps particularly are also not doing too much today. You did have some of those stocks have been moving quite volatile, but on the whole, the markets are pretty much where they are when they opened for trade this morning. Not too much volatility you're seeing in trade today.
Right, the general trend on the market so far seems to be higher, but emerging markets could be very close to their peak. That's the word coming in from Chief Equity Strategist at Morgan Stanley Asia, Jonathan Garner. EM equities attracted more than $100 billion in 2017, a feat that can't be replicated this year, says Garner. In a conversation with Bloomberg News, he said that there is reason to be cautious. Listen into a slice of that conversation.
Firstly, and most obviously, central banks are tightening, and that's begun in the US, but China has been engaged in ongoing tightening. You were just covering how good the China macro has been, but inflation is picking up there, particularly wage inflation. We've also got commodity prices on the rise, and that combination, particularly an oil price increase and increases in wages worldwide, that will eat into corporate profit margins, particularly out here in Asia, that's a big oil importer.
Right.
And then at the same time, we have a situation where valuations, and this is really the clincher, are exceptionally high, really other than in two sectors, financials and energy, but everywhere else we have valuations that are really 95th percentile or higher of the long-run history.
Is this just, though, Jonathan, as you're describing this, just an emerging market scenario here? Are we talking also about U.S. markets as well, and in Japan and elsewhere?
Yeah, so there are very few places in the world now where we haven't exceeded our base case targets. So our base case target for the S&P is 2750. For topics, it's 1820, Hang Seng 31,500. So now what we're doing is moving from kind of our central scenario that we thought markets could get to into a more kind of bullish state of euphoria, particularly on that valuation overshoot, which is typical of an end of the cycle situation. Very large retail investor inflows. Emerging markets had $100 billion of inflows last year, and that won't continue.
Jonathan, some say that if you track these movements in stocks, that is an indicator for the economies as a whole. We know back in 2000, what we found after with the dot-com crush is recession, particularly here in the U.S. and elsewhere. Are you seeing that is possibly going to be the case as well if we do in fact experience a crash on the magnitude of what we saw in 2000?
Well, the 2001 recession, I don't think it was really caused by the stock market declines of 2000, but certainly there are problems starting to appear, particularly in lower quality corporates in relation to the amount of leverage that they've taken on. So if you look, for example, at say the high yield part of the US credit market, we've already recommended going underweight that. And if you look out here in Asia, I think one thing that we really are interested in is the fact that the semiconductor tech hardware sector has stopped outperforming. So we made a big call 2 months ago to rotate into the final things that move in a bull market, which is energy, upstream energy, and financials. So the outperformance of upstream energy, and in fact the non-Asian parts of EM, like Brazil and Russia, that's ongoing now, that's a classic right at the end of the cycle phenomenon.
Jonathan Garner of Morgan Stanley, and here's an interesting perspective. He believes that emerging markets have actually peaked, and then foreign institutional investor flows into EMs are likely to sort of peter out. But here's a counter view, and the counter view is, and this is a chart, even after handily beating American stocks last year, Asian shares have actually gotten relatively cheaper to US counterparts. This is an interesting chart that gives you a sense of where valuations are, and not just in India, all over Asian markets we've been talking about how valuations have gotten expensive, and therefore the upside to the markets may be limited. But just compare this, and this is just a comparison between two spreads. The white line that you're seeing is the forward PE. This is the spread between the MSCI Asia Pacific Index and the S&P 500, and the blue line is actually price to book. Again, spread between MSCI Asia Pac and the S&P 500. And if you just look at the spreads on the forward PE, it's actually trading at a 13-year low, which means relative to the US markets, Asian stocks are continuing to trade lower from a valuation perspective. Does this indicate there is more upside for Asian markets? Yes, it does. Whether liquidity will follow, we don't know. Somebody like Jonathan Garner believes that foreign flows are not directed towards emerging markets, at least in 2018.
Interesting. That's the relative valuation and what it could mean for fund flows. Let's move away from the markets. Simplification of filing GST returns, a transition to the e-way bill, and of course also a breakup of the IGST between the centre and the states were some of the issues addressed at the 25th GST Council meeting that took place yesterday. The Fitment committees recommended that there will be lower rates on 29 goods and about 53 categories of services. This recommendation was accepted by the Council. The new rates come into effect on the 25th of January. Let's first hear out Payaswati Upadhyay reporting on the key takeaways and the important aspects of that GST Council meeting.
In its 25th meeting, the GST Council has taken several very important decisions, and I'd like to highlight the three key ones. The Council has decided to provisionally divide 35,000 crore rupees between the centre and states from the integrated GST collections kitty. This is to meet the shortfall of revenue collection that the states were facing. The second is on the simplification of the return filing process. The expectation was that there will be a simplified return filing process that will be announced by the GST Council, but they've sought more time on it, and they've said that they will discuss it in a video conferencing meeting that will happen in 10 days from now. The Council has also reduced the GST rates on 29 goods and 53 categories of services, and here I'd like to highlight two categories that stand out and are very crucial. The GST rate on construction of metro and monorail projects has been reduced from 18 to 12%. Also, GST rate on transportation of petroleum crude and petroleum products is reduced from 18 to 5% without input tax credit and 12% if you're going to avail of the input tax credit. In the fine print, there are also two other very important clarifications. One is on the value of, they have clarified that the value of exempt supply will not include the value of deposits, loans or advances on which interest or discount is earned. This will essentially be very useful for companies who have a major amount of interest income in their books. So what happens is when the interest income gets qualified as an exempt supply, you don't get credit for it. This was essentially meant for banks and NBFCs whose majority of income is interest income, but it also inadvertently brought into the fold a variety of companies who have a majority of their income as interest income. So it's good news for these companies. Secondly, the Council has also clarified when GST will need to be paid in a transaction that involves transfer of development rights. So what happens is when a landowner and a developer enters into a JDA or a joint development agreement, the landowner transfers the rights in the land to the developer. So the question was, when does GST need to be paid? At this stage, but there is no cash transaction that is happening at this stage. Only the right is being transferred to develop that land. So what the Council has clarified that this will need to be, the GST will need to be paid at the time when the possession of the right and property is transferred to the landowner by entering into a conveyance deed or similar instrument. But this deferment in point of taxation will not apply to the cash component.
Okay, Vaishnavi, thanks for that. Let's talk about the impact. Which companies are likely to react to these new rates? Darshan is here with a list of stocks that may be impacted by these changes. Darshan.
Yeah, so Harsha, not too much of an impact except for the amusement companies, but sentimentally positive for Maruti because the GST on old cars has come down both on the large car and SUV and on the other car. So it's positive because the old car market was simply not moving because of high GST rates. So now there could be a potential, and replacement market is a big market for Maruti. As far as sugar boil confectionery is concerned, it's positive for PNG because one of their key products, Wix, uses that. As far as cigarette filter rods are concerned, no material impact because the prices have gone up and they already paid something extra apart from the GST. Diamond and precious metals, yes, it's positive for companies like Titan and PC Jewelers. The other companies that we need to watch out for where the impact will come in, first of all, drip irrigation, Jain irrigation, extremely positive, and this has been spoken about for a while that the need to get down GST rates for important irrigation projects is strong. Construction of metro and monorail, positive for L&T. They're already doing the Hyderabad metro, but it also benefits companies like Simplex Infra as well as J. Kumar Infra. Transportation of fuel is positive for the oil marketing company. It's got down to 5%. For mining exploration services is positive for companies like Reliance, ONGC and Kane India. So it's upstream here. And finally, admission to theme parks. This is the big one. 28% was the earlier rate. Now it's got down to 18%. It's positive for companies like Wonderla as well as AdLabs. The management has been indicating that footfalls are simply not happening because of high rates. Because of this, they will be able to pass it on and ticket rates will come up, and that will aid the footfall. So extremely positive, and the companies in the amusement space, amusement parks, sector are clearly buzzing in trade today.
Right, Darshan, thanks for that. We spoke to two managements, L&T and Wonderla, to understand how they see this development. Let's hear them out.
It is a positive step in many ways, more than one. Number one, the capex of metros will definitely come down. 18 to 12 is a big step. Bulk of the metros, as you know, are financed by the government itself. through various loans that they take from multilateral agencies. Hyderabad is a one-off project which is financed by Larsen & Toubro, but most of the other projects coming out are government-aided projects. So the capex costs of metros do come down. Second is that there will be a significant reduction in working capital because a company like us moves resources from one state to the other. And in this kind of process, there is the fact that you pay the tax and then you wait for the credit later on, and therefore a significant blockage of money. Working capital coming down is a singularly a big financial movement.
Amusement park sector has been adversely affected because of GST. It was at 28%, which is much higher than what we were paying in the pre-GST era. Now they have, I think, recognized that, and they've brought it down to 18, which is a very welcome move for us. Obviously, our prices will come down by 10%, which is good, and so the customer will benefit from this, and we are hoping that will help us, bump up our footfalls.
All right, let's move on. The government has identified the 67 companies for alleged money laundering after the cash ban was announced. The government is now looking into the transaction done by these firms with other entities as well. Nikunj Ori, who's spoken to a government official, joins us with the details. Nikunj, what do we know and where is this investigation leading?
Post demonetization, the government had initially identified about 67 companies alleged for money laundering and depositing large amounts of money into their bank accounts and later withdrawing it. The investigation is currently ongoing on these 67 companies, and investigations are being conducted on companies that are associated or linked with these 67 companies. And remember, there are hundreds of companies linked with these 67 companies. A government official told reporters the real task for enforcement agencies now is to identify the real beneficiaries behind these fraudulent transactions. In a separate interaction with reporters today, Junior Minister for Corporate Affairs, Mr. P.P. Chaudhary, said that there were two companies identified that had deposited large amounts of money into their bank accounts and withdrew it later. These were one of the companies that was identified deposited about 3,700 crore rupees in its bank account and later withdrew it, while another deposited about 2,500 crore rupees in its bank account and the amount was later withdrawn. However, we do not know the names of these two companies, but we do know for sure that the government is going hard against these supposedly shell companies who undertook fraudulent transactions post demonetization. Over to you.
All right, Nikunj, thanks for that. That's an interesting development. Let's move on. Biocon, the stock of the company jumped more than 3% in trade today after the company announced a global partnership with Novartis. The two drug makers will jointly develop, manufacture and commercialize multiple biosimilars for patients worldwide. Earlier, we caught up with Kiran Majumdar-Shaw to understand the contours of the deal and the opportunities that it offers. Let's listen in.
It is very expensive to develop biosimilars, and it takes anywhere between $100 to $150 million a piece. So, this is the kind of investment needs, and therefore to partner with Mylan, where we basically share the costs of development equally, you can understand the kind of investments that need to be made. But, the interesting opportunity for us is that we will be able to have a larger portfolio at basically half the cost.
All right, let's move on. Singapore Stock Exchange's plans of introducing single stock futures of Indian companies is giving the NSE some cold feet. The country's largest equity exchange is said to have requested the SGX to delay the launch. Sajid is here to tell us what NSE's reservations are. Sajid.
Yeah, we saw yesterday Bloomberg's Shantanu breaking the story that NSE has asked SGX to defer the entire plans to to launch of single stock futures. Now, let me give you a background here. SGX already has Nifty futures there, and they've already started Nifty options. Nifty futures is a big product for SGX, and they have a licensing agreement with NSE. But to start single stock futures, they don't need a licensing agreement from NSE, so they can easily start. Now, what is the problem here is that a large part of that FI volume is coming into the stock futures. Already we've seen with the regulations getting tightening in 2017, we saw the ODI volumes shifting to Singapore, and now with this launch there, it will ensure that the remaining volume or a large part of the stock futures volume in which FIs are dabbling or are investing in the country again gets migrates, and that would hit very badly to NSE, because that's if you look at SEBI's regulation, SEBI's data which has come out for month of November, nearly 25% of the total open interest is with FIIs. So that's the amount which is going to be impacted when if Singapore starts the future single stock futures on Feb 5th.
But tell me, Sajid, does NSE have any locus standi to tell SGX not to do this?
It's a request.
It's a request. See, SGX has a stake in NSE, and they have a relationship going. As a part of the relationship, they have licensed Nifty futures in that country. Now, for single stock futures, there is nothing that you remember in the Gaurang Rajan days when rupee was under so much of pressure, and we saw the NDR market in Singapore being very active. The government couldn't do anything to stop it because it's a sovereign market, it's a free market. All that the Monetary Authority of Singapore said that if you see something unusual or something, you tell us, we'll take action against it. But it's a free market and they can do it. So today you have USD INR, which is taken off very well on SGS market, and a lot of FI volumes have gone to USD and INR there in Singapore market as well. So similarly, if when single stock futures comes in, subject to the approvals which are being awaited by SGX, it's going to be a good thing because it's a dollar-based contract. There is no translation risk which is there, and it's going to be easier for FIs to compliance and easy, and the cost of transaction in Singapore is much lower than India because you have your STT, you have stamp duties and other things coming in which inflates the cost for India.
Sorry, I have one more question. Would SEBI have, you drew a comparison between this and the INR futures. There was a regulatory element that, your control over your currency goes off. In this case, would SEBI worry about individual stock futures? We don't know.
No. See, if SEBI will have worry because the exchanges are going to red flag it, saying that our volumes are getting migrated to there. But the biggest worry is for the market and the market as a whole, because today you are looking at the data from the Indian market to look at how people are investing, what is the kind of sentiments coming in, or where the entire money is flowing in. Tomorrow you will have, if the stock futures, which mainly account for a majority of the market, because Nifty 50 futures is the one where you have a lot of trading that goes on. Tomorrow you have to bring in the data from SGX to see how to get a view of the Indian market. Now that's what is going to be worrying for some of the market participants, because they've started saying that already if you look at Nifty futures open interest is $9 billion in Singapore as compared to $3 billion or $1 billion in India. So it's almost 9 times the open interest in Nifty futures, which is getting traded today. So when stock future happens, of course it will take time because the market has to be developed, and SGX is going to do a market making scheme where brokers will come and do a market making for it so that liquidity comes in. But as and when, maybe not now, 6 months down the line or 1 year down the line, this stock futures will develop into a bigger market there as compared to the domestic market.
Interesting story there. Thanks, Sajid, for putting that in perspective. Out of time on the show. Thank you so much for joining us today.
Countdown is up next.
हमारे पड़ोसी मेहताज